Welcome to episode 75 of the Minds Capital podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lemus and Nicholas James. And today's conversation is with us. As we do every 25 episodes, we pull back the curtain and air some of the topics that we debate, discuss internally for you, our audience. We have a lot of them today, so let's dive right in. Nicholas, let's first talk about the podcast itself. How are we seeing it today at episode 75?
So 75 episodes in, we've done them weekly. So we started 1.5 years ago. And I think right out of the gate, we saw really good listener numbers. And I think that it's a signal that this is hitting a small niche market. The independent sponsor community is tight-knit. And so pretty rapidly, people in the community would see our LinkedIn post or even know the guests that we had on, if not directly, indirectly. And so through that, we got pretty high market penetration right away. And anecdotally, we know from going to conferences in the space that people are listening. We get a lot of people who come up and comment that they've listened into an episode or many. And so this has been a lot of fun, and it was also right in line with our objective of launching this podcast. We wanted to launch a media product for the independent sponsor community and also increase our own access to the people in this ecosystem. I think the benefit we went after was to generate inbounds, right? So how can we generate deal flow for our fund? We are an equity fund for independent sponsors, and the best way we found to generate inbound deal flow was to have a media product and solicit deals in a one-to-many media channel. And that's been going great. We see that our deal flow is compounding every month, even as we now are more than 2 years since the start. We're on our second fund. And so this objective has very much been met. I would say as a first-time podcaster, for me, there are two other benefits that also have emerged. Perhaps it's even more important. The first one is the learning. I think the podcast has sharpened our knowledge of the independent sponsor model. And every single week, we get a masterclass from someone who is a independent sponsor, and they all have their own approach, and we learn the nuances on a weekly basis, which help us become better investors in the space. I think the other benefit is the relationship building. We have guests every week. Many of these are best-in-class independent sponsors. I could name many of them, but we are proud to feature them. We're proud to be associated with them. And we form a relationship with them by featuring them on the podcast, which is quite deep. And that translates into deal flow from these independent sponsors down the line. And we've seen, I think of the last 5 deals we've done, 4 of them had been featured on a podcast previously. And so that's been really great because we learn their whole story when we have them on the podcast. And when we feature them, we also hear from our audience because they know these people. And so when we feature someone, we get the feedback that, oh, this person is really great. I worked with them on a deal. And so that's been a great way for us to vet people as well. And for the relationship building alone, this effort has been so worthwhile.
I feel like the inbound from our guests really accelerated this year, maybe even in the last 6 months. A number of our recent deals have been with podcast guests. And while I do think that that was something that we always anticipated could happen, should happen, we hoped it would, it's really kind of emerged, I feel, in the last 6 or 8 months as one of the best, the greatest benefits of the podcast is the accelerant to the relationships that we now have with sponsors that we're invested in. It jumps off the page how many of our existing deals are actually guests that we interviewed in the last 12 and 18 months. Great. Thank you for that, Nicholas. Then it's early August, so McGuireWoods, the, of course, huge annual powwow of independent sponsors is coming up quick. That is late October. We were there last year. We're going to be there this year. It's October 27th and 28th. That's a Tuesday and Wednesday in Dallas, as always. So we're looking forward to that, and it's going to be here before we know it. We also do an Investor Day. Last year was our first Investor Day. We did it on the day after McGuireWoods. This year we thought better of that, and we're doing it October 26th, the Monday before McGuireWoods. Max, tell us a little bit about how Investor Day went last year.
It was great last year, and I would say that we're moving it to Monday. Mostly, I remember because most of us had lost our voices by the end of the week at McGuireWoods because of so much networking, and I expect that to be the same this year. It's obviously a great conference and super focused on exactly what we're investing in. But Investor Day last year was really fun. It was our inaugural event, and this year we have a couple of great speakers lined up so far. We have Dara Sharif of Benchmark International, and he was just featured on the Minds Capital podcast, episode 74, which is a great listen if you haven't heard that one yet. We also have Edwin Yoon of the Road to Carry private equity newsletter. It's a really fun read, and it focuses on industries being rolled up currently by private equity. And additionally, we'll have a couple more speakers that we're finalizing now. So it should be a really fun day. It's really geared towards our limited partners, and we obviously go through lots of details on the fund and performance, and it's a great opportunity for networking as well. And I'm excited that it's before the the conference this year, so that we're full of energy and that our voices are nice and strong.
So if you haven't been to McGuireWoods, it's impressive. A lot of people, as you've heard, but it's also pretty overwhelming. And it's a speed dating style, as many independent sponsor conferences are. That's the format. So it really is a lot of conversations, and people literally do, by the end of day 2, start losing their voices.
It was at the Investor Day last year that I first realized that our group of LPs is a very homogenous group of people. That sounds not so good. I mean, really like-minded. And so you walk into that room, and that's when I realized, wow, these are all specifically here because they really care about the lower middle market private equity space and are specifically investing in Minds Capital because they want to learn more about that or are involved in one way or the other. Many of our investors are actually independent sponsors themselves and are doing deals directly, or they're lenders or vendors to the space. So this is a great way for them to get financial exposure without having to do the deal by deal investing themselves. And seeing everyone in one place like that last year was just a great place for community building, networking, and exchanging notes on what's going on in the market.
And we had about 30 or so come last year, and I think we're probably going to do numbers a little bit above that this year. At least that's what we're tracking on, right, Nicholas?
Yeah, we should be 2x that. And a lot of that is because we, of course, launched a second fund since last year. So we have a lot more LPs in the mix.
Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com.
We really launched that here at the beginning of 2026 as Fund 1 was finalizing deployment. And so far, it's going great. We've continued our cadence of committing to roughly 1 deal per month. We have closed 5 deals, or is it 6 actually, as of last week, in Fund 2 so far. And we have another 4 that we've committed to and will close here probably this quarter. And we're very excited about the cohort of deals that we're putting together. With these deals, we should be getting close to, or maybe a little past, halfway deployed. And our deal flow really is continuous, but our funds are not. And so our idea is that we will do continuous flagships as one finalizes deployment, and then we enter into the next one. So we haven't started fundraising for Flagship 3 yet, but the idea is that this will be up and running probably sometime in 2027, depending, of course, on exactly how fast the deployment of Flagship 2 goes. And so that's in the early stages of work, but really we imagine that it'll be mostly a copy-paste of Fund 2, since the deal flow and our underwriting process is already in place.
Why don't we hear some stats actually from Fund 2? You just said one or two there, Nicholas, but I know that we brought some from our CRM. Can we share some of those?
Yeah, so we've had an excellent summer intern here this summer, Hunter, and so he put together some data so far. Of the 6 deals and 4 commitments that I just mentioned, I think we're tracking very close actually to what our average was for Fund 1. I think the average so far is about 23 million of revenue, but 5 million of EBITDA and a 4.9x multiple on that in terms of valuation. And so that's really close to where we landed with Fund 1 as well. And there's a mix of industries in here. We've done a couple of healthcare deals. We've done 3 infrastructure deals, 1 tech deal. So we're trying to be somewhat deliberate about the portfolio construction. And I remember with Fund 1, we did 2 digital marketing agencies relatively early in the fund. And with that, we felt we were saturated in that direction. So then we focused our attention towards, for instance, healthcare or energy or whatever else you have. So we're trying to put together not an index fund, but a broad exposured fund within the lower middle market. I don't know exactly where our deal flow is these days. Max, it's been pretty solid throughout the first half of the year, right?
It's been solid. Yeah, we've had about almost 250 deals come through the end of July. That puts us on pace to do somewhere 420 or so deals, or to look at 420 deals this year, give or take. Those are leads that are coming in. That doesn't mean that, they're necessarily qualified, but obviously we have a process where a deal comes in, we qualify it, we review it, it moves basically to investment committee if we really love the deal, and that's when the 3 of us get together and independently score the deal and compare notes and then either approve or don't approve the deal. About 12% of the deals that come in, if you look at all the data, 12% of all leads actually make it to investment committee. So there's a lot of deals to come through, and obviously we're excited to see all these deals. And just because a deal is not a fit when it comes in from a sponsor doesn't mean that a deal in the future from that sponsor might not be a fit. So we're really on track, I'd say, this year to look at quite a few deals, and that's very exciting.
Out of the 10 deals we've committed to so far, 3 of them are what I would categorize as roll-ups or buy-and-builds. And so this is not intended to be a one-and-done platform that they organically scaled, perhaps with opportunistic M&A. The whole purpose of them is to grow through M&A. So 30% of the deals we've committed to so far are roll-ups. An interesting nuance there, and I think this is something that is still developing in our industry in general, is how do you raise money for them? Because when you're a fund, doing a roll-up makes sense because you have the dedicated capital there. When you're doing an SPV for a roll-up, you have a spectrum, right? You can raise upfront only for the first acquisition, the first LOI, the platform that you're raising for. That, however, leaves you in a bind for future add-ons in that you will have to do subsequent rounds, either with the same investors or new investors. But it makes it easier for that first deal because, first of all, the total equity stack is not that big. And also it's a very clean story. It's tangible what the equity is going to. On the other side of the spectrum, we've heard this on the podcast as well. You have people who raise 30 million or 50 million to do a roll-up, and the first one might only be $8 million, but we are calling the capital down the road. For us, of course, as an investor, that the feedback we give them is that's not perfect for us because we like to get the capital out the door, or at least have a good feel for when it should get out the door. So if they're only calling 20% of the capital that we've committed in the first year, for us, you're a fund with a lifetime. That is not the perfect fit for us, right? And so how do they solve for that? Another solution we've seen is our sponsors who do all equity. And they go very aggressive on the first equity raise. no debt at all, because then they can use debt for add-on acquisitions. So I think the industry overall is still trying to figure out what is the most efficient and scalable way to finance a roll-up. And we're seeing different variants of it. But I think the fact that we're now doing 30% roll-ups in Fund 2, where I think it was less than 10% in Fund 1, is a sign that they are accommodating our particular structure and needs, and that they're accommodating our timeline and all of that a little bit better.
I interviewed Jeff Homer, who was a guest on Acquiring Minds a couple of years ago, 2.5 years ago. And he bought a very small music school, almost as a side project, made some changes, discovered that there was an opportunity there, and proceeded to acquire 39 more. He did 40 acquisitions in 4 years. I'd eventually partnered with a family office at the time that I first interviewed him. And subsequent, in these intervening 2 years, he's now up to over 100 locations, and they've acquired, and they've moved into adjacent industries like dance and other things in youth enrichment, in the arts and in arts related youth enrichment. He's also started investing in this model, committed capital vehicles for roll-ups like what he did. There is a model here that he's been very successful with, and he sees a lot of searchers actually be good candidates for.
You think, when an independent sponsor basically raises capital up front, I mean, how is that different from just a traditional private equity blind pool fund?
Well, it's slightly different, and it's not a portfolio of platforms. It's one platform. And so it's more akin to the specs we saw back during COVID. And we've seen that. We had Zach Miller on, Will, I think about a year ago, who raised a lot of capital to do an MSSP roll-up. And they've been quite successful with it so far. But once you are trying to raise that kind of money over that kind of time period, you also rule out a lot of the more common investors in lower middle market deals, which are your friends and family and high net worth individuals. And you skew more towards more institutional and bigger family offices who have the time and check size to participate in that. So that's what I'm saying. That these architectures, if you will, we're still figuring them out, and it's quite interesting to sit at the forefront and see always people experiment with these structures. So anyway, Flagship 3, it'll be when it'll be. I think we're not in a rush to deploy, obviously. It's more important for us to wait for the right deals. That's how we're incentivized, just like the independent sponsors. And if it takes us 6 or 12 months longer to deploy Fund 2, that's not a problem. But we imagine that we will just keep doing what we're doing, which is investing $1 to $3 million per platform in independent sponsor-led acquisitions. And whenever Fund 2 expires or is finalized, we hope to jump straight into Fund 3. I think another thing that we have on our agenda for 2027 is about 20% of our audience for this podcast are international independent sponsors, and their capital markets are a lot less mature and sophisticated. You often see that their valuations and their financings are therefore quite a bit more creative as well, which can create value. But in any case, we're eager to explore whether we can support international sponsors with a dedicated fund for them. And so I think during this coming school year, we are going to see what the appetite is among investors to have such a fund, because we already see some of this deal flow from sponsors abroad, and there's nothing that tells us that the returns are inferior internationally. In fact, I could argue that they might be higher because it's less of a competitive process, and the valuations are better, and many of these companies have dominate their local markets and local home countries and so forth in different ways. So different risks, different rewards, but that's another fund that we are hoping to explore, and we should have more to talk about there in episode 100, which I guess is about half a year away.
Well, speaking of competition, that is something that we have felt in Fund 2 much more than in Fund 1, and it's let's unpack why we think that is. But specifically, there have been a number of deals that we committed to only to hear that they were oversubscribed, that there was either no room at all, or that that we were given a smaller allocation than was initially available that we wanted to make. So it might go from $1 million to a $500,000 check by us. This has been a little bit counterintuitive, I would say, because our check size in Fund 1 was quite a bit smaller at about $350,000. We thought writing $1 million checks in Fund 2 that we'd have access to more deals. We probably do, but the nuance is that now that our check size is material at $1 million, whereas $350,000 was smaller and could just kind of fit in almost to any deal. I'm speaking loosely here. At $1 million, you become a significant party on the cap table, and the other, sometimes bigger folks on the cap table or the sponsor themselves need to be a little bit more selective if it's oversubscribed. Is that your analysis, Max?
Definitely. I mean, I think the bigger check size has made it a bit harder to fit the full check in, obviously, sometimes. I think, the big issue for me is if a deal is really outstanding, it's just going to be harder to get into. There's going to be more folks trying to put money into it. And these deals really do stand out. I mean, we've talked about this again and again, Will and Nicholas, like if the deal is, a hell yeah, we're in. And some of these deals are, and everybody sees that's looking at the deal. They truly are very obvious sometimes when they're really exceptional deals. And those deals obviously attract equity a lot faster. The other thing that would cause a deal to attract equity faster is just the quality of the sponsor and the track record of the sponsor. So some of the best sponsors that we come across who've been on the podcast, who have done this a dozen times with great success, they're in high demand. And you actually see, I think it's really cool, they kind of control the process. They're almost telling us and dictating terms like, you need to give us an indication of interest by 10 days from now. Otherwise, you're just totally out of the running. We actually have seen that. And in those instances, you better move fast because other folks are looking at those deals and they're going to commit. So if it's a really great sponsor with a great track record, it just signals to us that we have to move faster. That being said, that's why the podcast has been so helpful, in building these relationships with these sponsors has been a real asset to us, because we can kind of check that off the box right away. We know the sponsor, we know the track record, we've already got references on them. So that saves us a lot of time.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Inzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out InzoTechnologies.com, INZO, or email CEO Nick Akers directly at nick@inzotechnologies.com. Having acquired Inzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@inzotechnologies.com.
But it is interesting. These seasoned sponsor deals that are really attractive, they go really quickly. I'd say first-time sponsor deals, even for great sponsors, anecdotally at least, they kind of move a little bit more slowly because you've got to diligence the sponsor, and all the capital is diligencing that sponsor as well. But yeah, it's certainly been a little more challenging this time around. We're also seeing more deals. I mean, quite frankly, we are seeing more deals. Not that we didn't see great deals in Fund 1. We're just seeing more deals in Fund 2. And I think we've hit a few bottlenecks in certain months where, we had an outlier month in February, for example, where we had 56 deals come in. That's really tough to get through 56 deals in 28 days. So I think just the flow of the deals, it's not always consistent. It's much easier to be faster, when you have 25 deals a month versus 50 deals in a month. But you have to move quickly, and the market is obviously very interested in this space right now. I mean, there was an article in Bloomberg the other day talking about independent sponsorship. I mean, there was an article in the Wall Street Journal the other day talking about it as well, in deal by deal private equity. So it's a hot area. Lots of people are trying to, invest in this space. I think we were pretty timely when we initially started Fund One. There's some other vehicles out there now. It is a bit more competitive. It makes me excited. It tells me that we're putting money in a desirable, smart space. We know that. We've seen some performance from Fund One already, and it's encouraging. So we've just got to continue to sharpen our tools and continue to engage with these sponsors to continue to build the relationships so that we, when the deal comes in, if we already know the sponsor, that's a big piece of the diligence that's already checked off, and then we can really focus more on the deal. But got to get faster. I know that was a theme in our last podcast, but I think that's going to be a theme going forward. Be diligent, but be fast if you want to get into these deals.
It's the good old story about supply versus demand. I think this asset class has heated up immensely over the last few years, and we talk a lot about how the volume of independent sponsors has grown, but the volume of investors has also grown. I think 2 years ago when we first launched Fund One, I talked about how I, as a sponsor myself, had found the debt markets to be quite mature in this industry. Tons of SBICs, a lot of lenders who are willing to borrow or lend against cash flow. But on the equity side, it was more a hodgepodge of some family offices that are half active and some high net worth individuals and maybe some SBICs that do sidecar investments in equity as well. But there weren't a lot of institutions going after the equity. That has changed, and we are one of the reasons or one of the participants that has changed that, of course. So when supply of capital goes up, you would expect that either the price changes and or the quality declines. On the price, meaning the terms that the sponsor set to us as investors, I don't know that we've seen a material deviation from where things were a few years ago. I think the industry norm that you can read in the various reports from Citron Cooperman and McGuireWoods has been quite established as these are the standard independent sponsor terms, and there's really a rallying around those terms, much like you've seen 2 and 20 in finance more broadly. Independent sponsors kind of have their same version, so you're not seeing too much experimentation around that, in my opinion, so far. On the lower quality, I don't know, that sounds harsh. I don't know that I have seen lower quality deals on average go through, but I would say there's probably more complexity now than there was 5 years ago, right? So we just talked about how roll-ups are happening at a higher degree within the deal-by-deal ecosystem, and that's a form of complexity that the ecosystem couldn't take down in the same way 5 or 10 years ago. And I think increasingly you will see bankruptcy specialists or growth equity opportunities that are not underwritten on EBITDA multiples and other forms of deals that occur more frequently and as a bigger and bigger proportion versus your completely vanilla 5-year organic growth case, base case. And so this is a process. The two things that we can do, seeing more competition for getting into deals, is Max talked about process already. So how can we get faster and have better communication? And we're always working on that, and we can probably always get better at that. And the other thing is, of course, how can we improve our value proposition as an investor? How can we be more than capital, so to speak, right? And I think our media arm is definitely one part of that has earned us a brand and some reputation so far, and also a network that we can tap into. And over time, hopefully, we can build out more services and value adds that we can offer up beyond the capital only. And this will be a way for us to get into deals and a strategic goal of ours to fulfill.
Another thing that we've seen in Fund 2, much more so than in Fund 1, is a number of deals that we committed to, kicked out, failed before they close. They failed to close. And there were a number of reasons for that in every case. But one other thing to notice about them is that it did seem to happen with first-time sponsors as opposed to these more experienced sponsors. Now, I'm really hesitant to brand first-time sponsors as that somehow being the reason. But it was also hard to deny that there was something of a correlation there. Max, how do you react to a deal from a first-time sponsor versus a deal from a more experienced sponsor? How heavily or not do you weigh that?
Oh, well, if I'm being totally honest, and I'll go through a little process here, but I just am more skeptical of a first-time sponsored deal. Now, that being said, two of our outstanding deals in Fund 1 that are really outperforming are both first-time sponsors. So there's a lot to be said for the first-time sponsor. And let me just caveat this with, we'll continue to invest in first-time sponsors, no doubt. And there's a lot of reasons why, but you're getting in with somebody who is going to focus all of their time on that one deal up front, or a team that's going to focus all of their time on that deal. So that's extremely attractive. They've got something to prove. If the first deal doesn't go well, there probably won't be a second deal. So there's all of these factors that once the deal closes for a first-time sponsor that make that deal very attractive for us from an investment standpoint, assuming it meets all the other investment criteria that we have. That being said, there are a lot of first-time sponsors out there nowadays. And I think as time has gone on and I've seen more and more deals, one of my first questions is this a first-time sponsor? And it just tells me, if it is a first-time sponsor, that we've got a lot more homework to do. And, we've got to diligence that sponsor. We've got to check references. We've got to get comfortable with that person. And we've got to understand that they have some standout characteristic that is likely to make them be a good independent sponsor, because there's no track record. So I think I've become more skeptical, even though the data from our deals that have done really well with first-time sponsors is very encouraging. I think it is more of a standout to me now than it used to be. It's a call out. If it's a first-time independent sponsor, we need to do our homework. You've got some extra convincing to do for us to invest, but we still want to see your deals, and we will still continue to invest in first-time sponsor deals, no doubt.
The correlation you're talking about, it could be a coincidence, of course, from our small sample set, but I would also highlight that first-time sponsors more frequently bring very unique situations. It might be the situation that catapulted them into becoming a sponsor, right? So we looked at one deal, we didn't commit to this one, but he had worked at this company for a decade as the general manager. And now the owner, who was well into his 80s, really wanted him to own the business. But he had to come up with, 2.5x valuation or whatever it was. It was a fantastic valuation. You have the management continuity. He's going to be full-time focused on the same job he's already had for a decade. And so there was a lot to like about that deal and that situation. And this is why first-time sponsors can bring some truly unique opportunities. And with those opportunities, they also bring some great valuation sometimes. Maybe they, fell into a situation where the valuation was just crazy, or maybe they were bidding for something and hadn't been colored by a lot of comps and other deals yet, so they just got a good valuation right out of the gate. But I think some of the confidence that Max is alluding to here, that confidence is shared, of course, not just with other investors, but also with the seller and the seller's representatives. And so if a deal drags on, there are many work streams to complete. If the sponsor has closed 5 other deals in the past, both the investors and the seller will continue to have a lot of faith in them, but less so, I think, a seller who's dealing with a first-time sponsor. Are they really going to be able to pull through with this? And so that could be a factor in why these deals come together. I think the other one is just, on several of the ones we saw, at least, the valuations were just so good that we believe, and what we heard from the sponsor is, before the deal closed, somebody close to the seller just finally got through and said, you can't sell it for this price. Now, as an investor, this tells me we were on the right track, right? Because the valuation truly was so good, and that's why we committed in some of these cases. And it would be fantastic if the first-time sponsor actually got the deal across the finish line. But sometimes, and we had someone on the podcast, who was that again? Will, who was giving us this point that if you're fishing for deals at 3.5 times EBITDA, very often you'll see failed LOIs because you might get them to sign the LOI, but between the LOI and closing, there are a lot of people who are going to touch that process and they might talk you out of it. So versus if you pay 4.5x, you're probably more in the fair market value range for most assets, and it's your chance of actually closing goes up.
You wonder if a more experienced sponsor aren't the ones to bring really low valuation deals because they have the expertise or they have the savvy to kind of preempt a deal they know in their gut can't get to close anyway because it's just too good a deal.
They can afford it too. An experienced sponsor already has the track record. We can believe in their value creation plan to a higher extent because they can prove that I've turned other or made gold out of other assets before. Versus for a first-time sponsor, a bigger part of their pitch is necessarily going to have to be the initial target and the valuation that they bring to the table up front.
Yeah. In some ways, we're kind of stating the obvious or calling out a pattern that would be the case in any commercial dynamic. If you have more experience, you're better positioned to go off and do whatever it is you're trying to do, and that's probably the case here. But just to reiterate Max's point that there might be a little bit more to overcome if you're a first-time sponsor with your sellers, with your prospective investors. But we remain as enthusiastic to talk to you as ever. It's just something that we'll naturally press on.
I mean, I think the valuation component, though, that's such a good point that you all brought up. I mean, whether it's a seasoned sponsor or a first-time sponsor, I think that the delineation is going to be proprietary deal versus bank deal on most of these. And in most cases, I think these proprietary deals are valued a little bit lower. And that's one of the benefits of going out and finding a proprietary deal. And so the question maybe then becomes, is a seasoned sponsor more likely to close a proprietary deal than a first-time sponsor? I mean, Nicholas, you were a sponsor, you have been a sponsor. How much harder do you think that first deal was to close than if you were to go do it again now with a track record?
The first deal is by far the hardest deal to close.
The other thing that is bound to contribute to this dynamic is the interest from the searcher side, the ETA side in the independent sponsor model. You've heard me say on the podcast before that anecdotally, I'm seeing a lot more searchers graduate into independent sponsors or attempt that. And in fact, some of the deals that we've invested in were searchers, found a bigger deal than any of the search models would enable, and became independent sponsors kind of to accommodate the deal. But there's just generally more interest in the independent sponsor model coming from ETA. In fact, the Acquisition Lab, longtime sponsor of Acquiring Minds, which is an education and community for people for pretty serious people about buying a business, has now added an independent sponsor office hours and invited our own Nicholas to host that office hours. But I say that as just more evidence that in the ETA world, you're seeing an appetite to learn more and more about independent sponsors. In fact, I had a call just last week with a searcher that I knew that had been on Acquiring Minds, an SBA searcher who now has gone off and is putting together independent sponsor deals. So we're bound to see, as the model grows, of course, we're just seeing more sponsors come in, but not just the kind of traditional model of people, spinning out of larger private equity shops and out onto their own to do independent sponsor deals, but also coming from sort of below market searchers moving up market into independent sponsor land. Any more patterns that we're seeing or pattern recognition that we're developing now, a few dozen deals in?
Well, just on that point about searchers, I have felt this too. Will, the first time you and I met was when I was a guest on Acquiring Minds a little bit over 3 years ago now. And the whole episode was dedicated to the difference between being a searcher and an independent sponsor, because I had done both. And you used me in that episode as a way to delineate between the two. And so we are pretty methodical in the way we go through that. And that little project of ours, of course, spawned a much bigger partnership that we are still enjoying together. But what we talk about there a lot is, of course, the difference in flexibility and autonomy, right? As an independent sponsor, you are not going into the business, but you're overseeing it more at the governance level. And because of that, you have the time and capacity over time to perhaps build a portfolio, which gives you, instead of having, what's the saying, all your eggs in one basket, you have a portfolio of crab pots, as I call it. And each crab pot can be a gold mine for you. And you only need one of them to strike in order to do pretty well. And then I would also say, there has, over the last 10 years, I think 10, 15 years ago, the people going into deal by deal lower middle market private equity were post-MBA people, young 30s operators, people who wanted to be CEOs. And the people coming in today, at least into the independent sponsor arm, are coming from PE. They're coming from big shops and want to run their own deals. And so they come more from the finance perspective and are not really that interested in being in the companies. I think there is also one final factor, and this is me speculating, but I think there were at one point so many self-funded searchers out there that for brokers, I think they became a little cautious about people who have never closed a deal and maybe don't have access to capital in the same way that traditional searchers did, or independent sponsors allegedly do. At least they present themselves as kind of deal makers and financiers as opposed to first timers in that way. So I think there's also a little bit, it's easier to present yourself as a PE guy, independent sponsor, as opposed to a searcher sometimes, I think, in 2026.
I think we're getting to pattern recognition with deals, and what and yes, I think the answer is that obviously as time goes on, we recognize, our job is to recognize these patterns as quickly as possible. I mean, we're not VC investing, right? We're investing in independent sponsored deals and, boring industries. The more boring, the better. So customer concentration, revenue growth, consistency of earnings, the industry, all of these things that everybody talks about, it is pattern recognition, and it is important. And, I think in VC, you can take a little bit more of a leap of faith on a theory or a concept or a disruption. But in the type of investing that we're doing, we want patterns. We want the buyer of the business to continue what worked in the past and accelerate what worked in the past after they acquire the business. Customer concentration is bad. There's going to be some industries where you can't get away from it, where you have contracts with the government or contracts with a railroad or a quasi-government entity, and it's a big addressable market, and there just aren't that many players. The waste business, for example, sometimes. So you're going to have customer concentration if you're going to play in some of these industries, but in general, it's a bad thing. And we've seen that it's a bad thing. And I think we've seen in certain investments that we've made that there's a reason why people are afraid of customer concentration. There's a reason why people are afraid of seasonality. These are things that you can kind of talk yourself into sometimes with investments, but ultimately, if you're looking at 420 deals in a year and the best 10 of them have no customer concentration, they have stable earnings, they're in a very boring industry that's very unlikely to be disrupted by AI, they're not likely to be dramatically affected by a downturn. You can kind of predict what the cash flows are going to be next year because there's long-term contracts. This is what we want ultimately. And I think we want, excitement and the ability to really supercharge growth in deals. That's what gets us excited. That's what gets us into that territory where potentially we could do 4.5, 5x on a deal. And we love that. But pattern recognition is extremely important. And to just ignore these basic fundamentals, I think it's going to cause you to get burned in a portfolio. But the quicker you can recognize these patterns, the more effective you can be at deploying this capital. First-time sponsor, that's pattern recognition. That's something we ask sort of upfront now where we may not have before. So I think that's something that we'll have to continue to develop. And if we're getting into we haven't really talked about AI yet and how that's affecting deals, but Everybody's using, let's be honest, everybody is using AI to perform diligence, to evaluate deals. AI is becoming a part of everybody's work stream. And what is AI great at? It's great at pattern recognition. So it's not going to get to the point where I think the AI is making the investment for you, but it can rule out a lot of deals based on pattern recognition and things that you don't want, attributes that you don't want related to that deal. The concentration, the vendor concentration, you don't want to buy a business if it's having a banner year and the last 2 years didn't look like that. And there's a reason why there was a banner year. You don't want to, pay a 4x on the best year ever necessarily. You might, but it's a pattern that you should recognize and diligence up front so that you can, exclude that deal from consideration or get to the bottom of it and move forward.
I think one of the other benefits of pattern recognition is the speed to make a decision. And so going back to the earlier point about speed being a key, something that we're always looking to get better at, and particularly as the market gets more competitive. As the pattern recognition gets better and the speed to decision gets better, that's a happy flywheel that I think we've already seen. I mean, you guys, there was a deal last week that, what was it? Like one of you called the other, and within 5 minutes, it was a green light. Just because you both the deal just jumped out at you. I'm not sure that a year and a half ago, the decision would have been that quick.
No, a seasoned sponsor, not their first deal, just, with a track record. So right away, that's a pattern, check the box. We know who this person is. We know they have a history of doing this well. Very boring business, like totally boring. But not going anywhere. And no matter what happens, this has to happen. There's no customer concentration. The value of their service is extremely high. The cost of replacing what they were fixing is like 10x the cost to fix it. So very attractive, lots of growth opportunities, kind of a niche market, but a nice TAM. These are things, like you said, Will, I don't know a year ago that we would have been able to be so quick to want to try to make a commitment to that deal. But here's the thing, we made a soft commitment, and guess what? We don't think there may not be room already. That's how fast these really good deals are going sometimes.
I don't think any businesses are boring, especially well-performing ones. So I object to that categorization. I think, when you've been investing in the same thing for a little while, you also know it's a CYA. You know which factors are going to come back and bite you. And to your point, we've seen in Fund 1, both on deals we're committed to and also some of the ones we didn't commit to because of one factor here or there. We've seen the seasonality or the customer concentration or the lumpy project revenue quality actually come back and bite the sponsor. And so when you've seen that, it becomes a protection mechanism to avoid it in the future and stop rationalizing it. And some deals are just clean, and they're boring in the sense that you can't see the 100x on them, but they're clean in the sense that you know they're gonna plod along and do pretty well and be very, very steady. And the thing about steady assets is that a steady asset with a good sponsor has upside potential, because you could suddenly, and we talked about this on the podcast with Andrew McDonald recently, you have a steady asset and you're just holding it, a bluebird event can happen. A strategic buyer might suddenly really, really need your territory, or the industry goes through a 2-year phase where multiples really, really spike, or you're able to, because of some hire, break into a new product category or something with the business that triples its TAM. So these things can happen if you combine a solid asset with really great stewardship. And that's what we're on board for. Great sponsors with solid assets.
But guys, on this point about patterns and all of the criteria that I've heard you both just say, quality of revenue, et cetera. If everybody is following the same, kind of has the same formula, the same check boxes, the same patterns they're looking for, where is it then that a lower middle market investor finds their alpha? The deal flow itself, the access to the deals itself? Because traditionally in investing, you'd say, to find alpha, you have to do what the crowd is not doing. You have to find underpriced opportunities. And so if we're all acknowledging that in fact following the traditional pattern is the right move here, where's the alpha?
We had a guest on at one point that simply found alpha in a market in which where nobody else was currently investing. That was the Western wear deal, where he was buying up Western wear shops in smaller Texas towns and rolling that up, and not a lot of folks were looking at that at the time. So I do believe that the deal flow, finding something a little different, finding something a little different that not everybody is looking at, not necessarily HVAC at this point, not some of these other segments that have been put into sort of late innings. I think a lot of the alpha still comes from finding great deals at a reasonable price, and as Nicholas said, putting the right stewardship, of course, into that deal. Somebody with direct industry experience, a great board, great corporate governance, great folks involved in the deal that can make introductions to, other organizations that can help grow sales, that can help connect you with suppliers, somebody who's already been in the industry. So connecting the steward with a deal that's very well priced, I think that's a winning combination. And that's a boring industry. In most cases, I say boring. I know Nicholas likes boring and says boring isn't boring, but I still find boring
we say it
to be
affectionately.
A good thing. I say boring affectionately. And it is boring. I mean, listen, if guys are going out and cleaning up a certain thing and inspecting it day in, day out, that's probably not that exciting for that person who's doing the inspection. But so boring in the sense that it's not, they're not flying SpaceX rockets or anything like that.
Boring in the sense of it's a very mature industry.
Mature. Not a lot of surprises, I think. Lack of surprises, continuity.
Talking about surprises, Charlie Munger said that, tell me where I'm going to die, and then I'll just make sure never to go there. And I think on your question to where do you find alpha is a little bit the same thing. It's not a static answer, because if it was, we would have figured it out by now. Everyone would have, and they would have gone there to hunt superior returns. So this is always changing and very situational. And in this market and the ecosystem, the situation involves a private off-market transaction, off-market in the sense that it's not public, and with the sponsor that is of varying quality. And a lot of the people in our ecosystem are very strong. The amount of EQ and IQ you need to excel as an independent sponsor, we've covered this extensively in the past, is very high. And so for us as LPs, it's a privilege to work with many of these folks. It's a privilege to interview them. And we're starting to see that now that we're 1 year. I think our average age in Fund 1 is coming up on 1.5 years across the portfolio. And we're seeing the quarterly results come in from Q2. And it's really, really encouraging to see that some of the value creation plans that they presented to us back in 2024 and early 2025 are now coming into fruition. And that's what we're talking about. These are good assets with limited downside and really great, successful people driving them for growth.
And I think that point about alpha and where to find it, if you're following a pattern that everybody else is as well, probably applies much more in the public markets that are much closer to being perfect markets, perfect information, exactly. Highly liquid. In the private, hairy, vast, opaque, lower middle market, there's alpha everywhere. So it was kind of an academic question, but don't get me wrong. I think that following a traditional pattern or formula of high quality revenue, good business fundamentals versus not, and pairing that with finding great deals is a winning combination. That is kind of the lower middle market. That is the lower middle market playbook.
There is alpha everywhere. That's a great quote, Will. We need to use that when we promote this episode.
Okay.
But on that note, and as you brought up, and one thing we failed to mention, and what Dara Sharif said, again, we're bringing him up for the second time in this episode, but he made a great point from the perspective of an investment banker that sometimes independent sponsors are not going to get that perfect deal where everything looks good and looks clean because it's going to be bid up by a funded PE group or a strategic. The other element I think that you touched on, Will, but that we didn't really focus on is that there needs to be some hair on the deal, and the sponsor needs to be the right person to manage that hair and to steward the business through that, whatever that issue is, to help get that resolved, to get that business into that optimal area where that strategic is interested at the next level. And then that deal can get bid up. So then you get that potential multiple arbitrage as well. So I think the hair is part of the alpha if it's the right sponsor to tackle that problem.
Boring versus sexy. Sexy is AI these days. You see it in Silicon Valley, where a lot of people are developing theses around rolling up an industry and putting in AI. It almost feels like certain startups or VC-funded ventures are converging with private equity, because that's also, of course, something that we're seeing a lot in our world. Essentially the same thesis or the same sort of strategy. Are we investing in that? How much are we seeing that? So to be clear, we're basically bringing AI, injecting AI into a quote boring or mature industry, is really the core of the strategy, or one of the core pillars of the strategy.
We are seeing it. I think from our standpoint, at this point, that needs to be a feature of the deal potentially. It's not going to be the reason why or the thesis that's going to drive our reason for investing. The deal needs to be solid and to have a good growth outlook without being disrupted by AI or impacted by AI. So I think it's a feature. If AI could help with the workflow of the business, yes, of course we like that. And I think every business at this point is looking to implement in some way, some form of artificial intelligence to help streamline workflows. But if it's really the core thesis that we're going to fire everyone and bring in AI and it's going to reduce our costs by 40%, that's probably not something that I'm super interested in looking at right now.
Too speculative?
It's too speculative, and I think that's more of a story than a realistic probability for a lot of these businesses right now.
I think it just doesn't jive with what we're doing. In private equity, you want targets where continuing assets will give you some level of success and a good favorable outcome. And you want to underwrite what you know, and you want to avoid what you don't know. And so when you see a pitch, and there are many of them, the whole we're going to buy a boring business, an unsexy business, and transform it with AI because we have XYZ angle in tech, and we're going to double the margins and triple the sales growth. It's, as you say, too speculative, and you're then betting on things that you cannot know anything about, especially given the rapid pace of development within AI these days. So Max says it's perfectly. If you present to me, here are the 5 things we're going to do to grow the business, and you can legitimately show that they are archaic on technology, and you're going to implement a level of technology and improve processes from that, great. But if the whole thesis relies on it, I think you're looking more for growth equity style investors or California-based venture investors who understand that game better, I think, than typical buyout investors.
I think it's also, there aren't enough examples of successes here in the market yet. It's still early enough that I can't point to any where somebody came in with a thesis and disrupted a boring business with a kind of AI first approach, AI first strategy, and had a win thanks to that strategy. We're just too early in AI to have seen that yet. So it all remains unwritten.
I have no doubt in the macro perspective here, the way AI helps research, the way it helps productivity, the way it helps innovation. This is very obvious and we can see it. But to your point, I've been searching high and low for the last 6 months for real life case studies, especially in private equity in the lower middle market. And I really can't find that many who are willing to come on the record and talk about here's how we shrunk our back office by 13 people, or a headcount has gone down, or here's how we did this much more outreach, or whatever it would be. It's just you would think they would exist by now just from our anecdotal usage of AI ourselves, because I personally feel a lot more productive with it. I am. And I think we all are feeling that. But at the organizational level, implementing it in a way that really accelerates the business in a way that your competition cannot follow, I don't know that I've seen that. It's speculative. And again, the pace of development is so fast that who knows where we're going to be in 5 years. So when that's what you're underwriting for, it's just really hard to build conviction.
The other thing you wonder is pre-AI, there was always the playbook of putting tech into an under-teched business. So get out with the facts, in with the CRM, and in fact, you still see that. And so, but what that might tell you is that what makes you wonder is how much the CRM, how much value it actually added. I've heard people say that all of the operational efficiencies brought by tech is often juice that's not worth the squeeze, because it means a lot of change management internally, and there can be resistance to that. I don't want to sit here and say I'm advocating for pen and paper, but I've definitely heard multiple sponsors and searchers say that you got to be careful not to oversell to yourself that putting in a CRM is going to be a magic wand. And so I think we can apply the same sort of skepticism to AI, especially given that, Nicholas, to your point, there aren't all these case studies coming out of magic new cash flow.
Everybody wants to believe that it's going to just transform every business, and it's going to make everybody's life so much easier. I think it's a tool like any other. For us at LCS, it's similar to Microsoft Excel. It's something that you have to be proficient in, and you have to stay on top of. And you want your younger people to be super users and teach the rest of the firm how to use these new features to be efficient. But it's not going to be the whole business. You're still going to need people. You could easily overdo it. And there's a lot of companies right now that are scaling back token spend, I know, with Claude and others, because it's the AI is starting to inject itself into all areas of the business, and it's getting really expensive, and they're not seeing the return on investment for it. So I think it's a balance. I think it's a tool. I do believe it's going to change business in general and make everybody way more efficient. And I think it already has. I would just say that as well, if a business that we're looking at, if the thesis is that this sponsor can disrupt this business and disrupt this industry so drastically with AI, that's probably not something we want to invest in.
Exactly.
Because what's the next iteration of that?
Exactly. And actually, and on that point, this asset class of lower middle market businesses, which isn't necessarily by definition kind of boring, people heavy businesses, but it does seem to, certainly those types of business seem more in evidence than some sort of kind of professional services or more white collar business. It's often very blue collar, very kind of ultimately physical service delivery businesses that we're looking at and investing in lower middle market. And those are happily and hopefully some of the very last where the service itself that's being delivered will be disrupted by AI. So I'm actually just making a larger macro observation that we find ourselves in maybe the best or most protected asset class from AI.
Well, I would also say we don't often invest because of AI possibilities, but we quite frequently would choose not to invest because of AI threats. And that is real. across many industries that we just don't know how it will impact, anything that has to do with vehicles, frankly. At one point, we all know they're going to be self-driving. We just don't know when. And anything that has to do with content creation and production and distribution, this has already been disrupted. So you got to be careful. And so it's one of our checklist filters is, can this be threatened by AI? And I agree with you. In the lower middle market, it's possible you'll have a lot of holdouts. A lot of these businesses there is no obvious link to a large language model putting them out of business.
Yeah. So to kind of distill that point in the earlier one, we see AI affecting an industry in a material way as a downside to be protected against, not an upside opportunity that we would invest in.
I agree. And let's be honest, we're not experts in AI. I mean, we're not VC, we're not tied into Silicon Valley. We don't know where this is all headed. And this is going to change so many times as they're talking about open models versus Claude and, tokens and, protecting your data that's just kind of not the world that we play in. Yeah. And I think we're thinking of AI like being able to answer the phone at a call center, maybe for a service business, like a home services business. I think that's very different than, some of the things that AI is going to be used for the super technical businesses that we're not investing in.
Great, guys. Well, we actually had a few more things that we might have talked about, but we are fresh out of time. Any final thoughts before I close this out?
I have one.
Yes.
This is actually, I think, a question for Nicholas, who's he's in charge of initiating wires when we invest in companies. Do you ever get nervous when you have to send $1 million to somebody?
That's the Minds Capital Treasury Secretary. I got butterflies earlier today. I was wiring $420 to our website guy, and there's something about it. But one idea for people who are wiring big amounts of money, and I made a post about this about 6 months ago, I think, is do a test wire. Send $9 3 days ahead of time to that account and have them confirm it, because resending or wiring to the same place a second time is a lot less nerve-wracking. So that's a small tip from me.
Great tip.
So is that a yes?
Yes, for sure. I don't love moving big money around in any direction.
Okay. Good to know.
Okay, guys. Well, we'll wrap it there. Thank you, audience, for tuning in for these 75 episodes. If you have suggestions, feedback, good or bad, let us know. You can reach me at will@mindscapital.co. And we want to thank our guests, our 70+ guests, all the independent sponsors that we feature on the show every week. We appreciate their time, their willingness to come sit in the hot seat. And as we said, for many of them, the relationships that have evolved and deals they've invited us to invest in. So we thank them as well. And we'll see you all in episode 76. Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.